My partner, Ken McElroy, and I, we bought a property in Austin, Texas. It was $31 million. Beautiful property, but we had to be smarter. We had to work harder. And the reason we could buy a $31 million property is because Kenny is also a builder. So he can take the property, take it from 31 million and step it up to 45 million. Let me say that again. Bought it for 31 million, but our plan is to take it to 45. That's our plan. That's how we're going to make our money. So it depends upon what skills. Can you take a property and fix it? So I'm going to show you what I think is the most important thing for right now is this. All of us, Aussie or American or whatever, rich or poor, smart or stupid, male or female, we all have four intelligences. There's mental, emotional, physical, and spiritual intelligence.
Real estate is at all-time highs. For most people, that's a warning sign to stay out, but not for Robert Kiyosaki. He just bought a $31 million property in Austin, Texas, and his plan is to force its value to $45 million. This isn't gambling. It's strategy, built on decades of lessons from boom and bust cycles going back to the 1980s. If you want to avoid riding the Titanic down in the next crash, you need to see how he's positioning himself now.
So in today's market, with markets at all-time highs, you've got to be smarter on your four intelligences, okay? Because you've got to get smarter mentally, emotionally, physically, and spiritually. So let me explain mentally. Mentally means you've got to look at the property objectively. You've got to look at the numbers, just the facts, just the facts. You know, mentally, what are the facts? What is the rent? How much is the stamp duty? How much is this? How much is that? Just the facts. What gets people in trouble is when emotions kick in. Oh, this is a good deal. Because if you get too excited, or for many people, they're too afraid, and they're afraid of making a mistake, that's a negative emotion here. So get the numbers, keep your emotions in check, and then you take action. So like I said, even though in America, the property values are really high and $31 million is a lot of money, we knew that physically we could improve the property and take its value up to maybe about 45 million. We know that, we're not emotional about it, and we can do that here. So those are some of the tricks. And the spiritual part here is this, is what are you investing for? So one of the reasons I invest in property is because spiritually, I don't like paying taxes. You know, it just bugs me. So I use debt and I pay no taxes when I'm investing. So those are some of the things I think about here. But spiritually is that we now own about 8,500 rental properties. Spiritually, we're never going to sell this thing. So our plan for our property is we're going to put it into what's called a CRT, a charitable remainder trust. And we'll package it in all this. All of this, brain work, physical activity, and all this, goes into a trust. And long after Kim and I are gone, that trust will still provide cash flow for the people out there. You know, it'll do good work for many, many people. So if you're just in it for the greed, that greed is more here, but this here is a spiritual side of here. Why are you investing it for? You're just going to make money? Or are you passing it on to your children or your grandchildren? You know, there's got to be some kind of love in this whole thing here. So those are very, very important things here to remember, especially in this marketplace today. This is probably the most important of all intelligences when it comes to real estate. So let me explain why emotional intelligence is the most important. The problem with real estate is this: it's not liquid. You know, if I buy a stock, let's say Apple Computers or Apple, I make a mistake, I can sell it today. You know, I can buy Microsoft and sell it today. But the trouble with real estate is not liquid. You can't sell it if you make a mistake. So if you make a mistake and you bought it up here and it's going down this way, you might be riding the Titanic down. You'll just keep going down with it because you can't get out. Okay? So let's say I make a mistake. Let's say I buy this property. Let's keep the numbers easy, $1 million. And it starts to drop like this. Have plan B. Let's say I make a mistake. Let's say China decides to go bust. If it starts to go down, what's plan B? So let me say it again. We just borrowed $31 million. $31 million is a lot of money. The good thing is it's free money. They just give it to you. If you have a good project and you have a good mental, emotional, spiritual plan. We showed the banker how we're going to take the property from 31 to about 45. The 45 valuation is dependent upon how much rent can we increase. So the good thing about Austin, Texas is possibly one of the hottest real estate property markets in America today. So even though it's very expensive, the good news is people are evacuating Washington State, Seattle, Portland, and California, and their favorite destination is Austin, Texas. So the prices went up in Austin, so we had to go in there and take a look at it. And at that moment, we found a property for $31 million. And our question is, can we get it up to a valuation of 45? And the way we're going to get it from 31 to 45, we're going to put improvements in it and increase the rents. So we had a plan how to do it. And it doesn't make any difference if it's 31 million or 300,000. The plan is always the same. You have got to be smarter. You've got to be smarter here, smarter emotionally, smarter physically, and smarter spiritually. So those are the things I like to talk to you about. Another thing I would like to say is this: have a partner. You want somebody to talk to you. I'm only here because I had a smart wife, Kim. She is really, really smart. In fact, most of my friends say she's 10 times smarter than me when it comes to property. And she is. She loves property. In 1996, my wife Kim and I came up with this board game here. It's a cash flow board game. That's my yellow Ferrari out there. And this here is what's called the rat race. And this is what you go to school for. You go to school, you get a job, you get stuck in the rat race. And outside here is called the fast track. In the real world, there really is a fast track. It's called the accredited investor. In America and in most parts of the world, if you are not substantial, you have not enough money, or you don't have enough education or experience, you cannot invest out here. So that's why in 1996, Kim and I created this board game here. And when you go to college or you go to school or you graduate from technical college, this is where you get stuck here. You go to work, just keep paying taxes here. So this was 1996, and this is what made our program so different here. This is the book, Rich Dad, Poor Dad here. This came out in 1997. Okay? This is called a financial statement. Now, when I go to my banker to borrow $31 million, I've got to have a financial statement. If I go to the banker and say, well, I don't have a financial statement, I have a tax return and I have a bank statement, they won't talk to you. So the key, my way of saying it here, for you to get from here to here requires this here. So that's why we created the cash flow board game. And these are some of the differences here. There's 3 parts to financial statements all over the world. They're always the same. There's an income statement. It's oftentimes called a P&L. This is called a balance sheet, assets and liabilities. And this here is called the statement of cash flow. All over the world, it's the same. Now, the reason this is important is this, the facts. What are the facts? So when you look at the facts here, it said, okay, I got this here, I got this here, this here, this here, this cash flow. So the mistake that people make is they call their house an asset. But if you look at the statement of cash flow, their home is here, and the cash flow pattern is going this way. In other words, every month, your money is flowing to the bank. But if I buy a rental property, this is the difference. It flows into my income statement. So this is a liability. This is an asset. So the reason my wife and I are rich is we only focus here. One more thing is when you listen to the language of rich people and poor people. Poor people always talk about how much money am I making and how much are my expenses. How much money and how much are my expenses. The rich are always talking about balance sheet. What's on your balance sheet? So the reason my wife and I created the cash flow board game, this is in 1996, was to take your brain and put it down here.
Robert Kiyosaki opens with a blunt truth. This market is as expensive as it's ever been, which means emotions can destroy you faster than ever before. But he isn't sitting on the sidelines. He and his partner Ken McElroy closed on a $31 million deal in Austin, Texas. Not because it was cheap, but because they had a plan to increase its value to $45 million through improvements and rent growth. This isn't new for Kiyosaki. He's seen every cycle, from the savings and loan crisis in the late 80s, to the dot-com bubble, to the 2008 crash that wiped out millions of homeowners. The difference between those who survived and those who went bankrupt was one thing: intelligence. Not IQ, but mental, emotional, physical, and spiritual intelligence. He breaks it down. Mental. Get the numbers straight. Look at rents, taxes, cap rates, just the facts. Emotional. Don't get caught up in fear or greed. Real estate isn't liquid. If you buy wrong, you're stuck. Physical. Understand how to actually improve the property. Renovations, management, repositioning. Spiritual. Know why you're investing, whether it's for cash flow, tax strategy, or building a legacy. Kiyosaki warns that today's market feels a lot like previous peaks, when amateurs bought emotionally and were crushed when prices turned. He reminds viewers to always have a plan B. If rents fall or markets dip, you need a way to pivot. Otherwise, you could ride the market down like investors did in 2008. He highlights Austin as a prime example. It's one of the hottest real estate markets in America, driven by migration out of California, Seattle, and Portland. That population surge is why he's confident he can raise rents and boost value, a key move during high inflation periods like we've seen since 2020. Then he shifts to financial literacy, the tool that allowed him to borrow $31 million legally, structure it for tax efficiency, and pay almost nothing in taxes. This is a cornerstone of his philosophy, rooted in lessons from his best-selling Rich Dad, Poor Dad and the cash flow game he created in 1996 to teach people how to escape the rat race. Kiyosaki points out that most people still treat their home as an asset, even though it takes money out of their pocket every month. He focuses only on assets that generate cash flow. This is the mindset that made him rich, not speculation, not gambling on appreciation. Finally, he reminds viewers that financial education is a lifelong process. He openly shares that he's made mistakes, lost money, and learned the hard way. But every loss made him smarter. That's why he believes games like cash flow are the best teachers. They let you fail safely, over and over until you master the game.
Again, there's three parts to a finance statement: income statement, balance sheet, statement of cash flow. So when you're playing this cash flow board game, your hands are moving, you're doing the math, very simple math. You can add, subtract, and that's all you need. But you've got to know where to put the numbers. So that's why the cash flow board game, it's all over the world. There's cash flow clubs all over the world here. So this is important here. Now, this is the other part about it here. This was book number 2 in Rich Dad, Poor Dad. It's called the cash flow quadrant. This stands for insider. People think it stands for investor. No, it stands for insider. Inside investor. E stands for employee. I got a job. I'm a clerk. I'm a banker. I'm a whatever, truck driver. Or I can be a doctor, or a lawyer, or a computer programmer, or something like this. Self-employed. E and S. Most people go to school to be E's or S's. This was my poor dad. This is my rich dad here. B stands for big business. It also stands for brand. And generally a brand has 500 employees or more. In the tax law of America, you have to have 500 employees here. And I stands for investor, but these guys invest also, but most of them invest in shares, bonds, ETFs. I don't know what else you call those things. They invest from the outside. The moment you go into real estate, you become an inside investor. That's why you've got to be smarter. So I only invest inside. I own no stocks. I own no shares. I don't do that because I'm a capitalist I create my own assets out here. Like, not only did I buy property, I also started 2 companies this year. So although I have shares, they're shares of my company because I am an inside investor. Those are the differences. So in 1996, we created the cash flow board games. There's a lot of cash flow clubs there. There's still cash flow clubs going there and all that. But it takes, the reason this works is because it's not just mental, excuse me. To play the cash flow board game requires all 4 intelligences. You see, you can know the answer, but you still have to do something. So you have to fill in the numbers here. When you're filling in the numbers and you're erasing and all this stuff, your mental, emotional, and things, you're all getting smarter. So games are the better teachers because they involve all 4 intelligences: mental, physical, emotional, spiritual. So that's why games are the best teachers. I learned about investing playing Monopoly. 4 green houses, 1 red hotel. 4 green houses, 1 red hotel. So when I was a kid, and my rich dad had little green houses, and I was growing up, and I would help him with his green houses. And then in 1967, he bought the red hotel. That red hotel is still there in Waikiki Beach. It's called the Hyatt Regency. So you have to have a plan also. 4 green houses, red hotel. Rich Dad doesn't own the hotel, he owns the land. So Rich Dad worked his plan. So as a young man, I understood that. And that's why Kim and I created the cash flow board game, because it involves all 4 intelligences, and you can have fun learning. Most important thing, if you lose money, it's only paper money. That's the most important thing. Lose, lose, lose. You get smarter. But the reason so many people are not rich is because they went to school and they're taught if you make a mistake, you get fired or you lose everything here. The purpose of the cash flow board game is move your brain over here, make mistakes, and lose, 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 because you get smarter, smarter, smarter. That's how I got smarter. So Kim and I created this game in 1996.
Markets rise, markets crash, but those with the right education always come out stronger. Kiyosaki's message is clear. In a market this hot, intelligence is your only edge. Be mentally sharp, emotionally calm, physically prepared, and spiritually clear about your goals. Because when the next downturn hits, only the prepared will turn disaster into opportunity.
So the final thing, I want to show you this here. This is what Kim and I do. Let me show you this here. So this here is my sketch of a financial statement, income, and I'll show you the statement of cash flow, balance sheet. This is, I started, my first investment was an $18,000 unit in the island of Maui. I wish I'd kept it. But back then, it was a lot of money, 18,000 bucks. So I put $200, it was a $2,000 down, 10% down. So I put it on my credit card. So I bought my first property. And since then, I just kept investing, made a lot of mistakes, lost some money, made some money, but I got smarter. So today, let me explain how I make my money. So let's say I have a business. So let's say it's a Rich Dad business here. It's an asset to me. And let's say it puts money here, income. And let's say let's get the numbers, it's $1 million. If I just keep that money, the first line item expense is tax. So let me show you the tax consequences here. If I make $1 million as an employee, I'm going to pay 40% in taxes. So $400,000 goes to taxes. If I'm a doctor or a lawyer or a small falafel shop owner, I make $1 million, I'm going to pay 60% in taxes. So $1 million here, I'm going to pay $600,000 in taxes. If I make money here as a Rich Dad company or a big business, I'm going to pay 20% or $200,000. And as a professional inside investor, 0. So let me tell you how I go from 20% to 0% here in taxes. And this is true all over the world. So the way it works is, here's $1 million. If I do nothing, and let's say I'm an employee, they're going to take $400,000 right off the top here. So what I do instead, and this is where real estate comes in, I borrow $4 million. So I have $4 million in debt here. So I take the property up, borrow 4. That gets my real estate, this is real estate here, it's now 5 million. So let me explain this to you. 1 million, borrow 4, it becomes 5 million. And because it's $5 million, I get to appreciate, depreciate, and amortize this, not that. And because this has so many losses to it, 0 tax. But you need a good accountant and all that stuff.
What do you think? Are we headed for a repeat of 2008, or will smart investors like Kiyosaki keep winning even at today's prices? Tell me in the comments. I'd love to hear your thoughts. And don't forget to subscribe so you don't miss more insights like this.